All right, well, happy September 15th. It doesn't look like anybody's joined live yet, but I'll still do some recordings to have some exercises recorded as samples for chapter 1. But before I get into that, I just wanted to remind you about group selections as posted. I'll show you that announcement in a second. Just a reminder too to make sure you have your AME access set up, because everything but the group project is on AME. So you definitely want to set up that access to this course if you have not already. And then I'll do some workbook exercises. I'll record those today. So I'm going to switch my share for a second. And that's this one. All right, so I'm just switching things around in case anybody does join. All right, so here we are. We're on chapter 1 this week, and we had the posted lecture. I think I posted that on the weekend, actually. And what I wanted to point out to you right now is there are group selections open. So there's an announcement on here I need you to pay attention to if you want to pick your group. Otherwise, I will assign the group. There's a Google Doc connected here, which has all of the students' names as of 2 days ago. Any new students that join or drop, I'll update the list accordingly. Or if you find that your name's missing, please reach out to me and I'll update the file. So you can feel free just to change the no's to yes if you want to create a group with a few of you. The plan is to have no less than 4, no more than 5 people in each group. I'll give you till next Monday to pick your groups. Otherwise, I will assign and then circulate that back out to the entire class. So for today, I'm going to pull up the workbook. So I've downloaded the workbook in PDF format. And what we'll do is we'll walk through some examples. So for this first question, this is the AP sections I find are the most useful to do some demonstrations for the relative materials. And I'll do a handful, probably 6 to 7 of them or so from each chapter, unless someone brings up a specific problem that they would like me to go over. So I'll start with question 1A, AP 1A, and this one here is talking about perpetual inventory system, and it's given us 3 transactions to record. In the first situation, we have goods sold on account. So we're still talking about accounts receivable, which is a refresher from something you learned in accounting 1100, likely last term or the one before. And so we have this goods sold on account. Okay. So in this situation, and it's not letting me type. Okay, I apologize. It's not working. I'm going to switch to this then. So this way you don't have to watch me type. I'll walk you through verbally. So in this situation, we've sold the goods on account. In that case, we need to credit our sales revenue to increase revenue for the $30,000 in sale amount. And we've set up an accounts receivable from that customer for $30,000. But don't forget, when you sell goods as an organization, you always have 2 sets of entries for a sale. So in this case, we have a debit for our cost of goods sold, so the expense account COGS for $18,000, we're told is the cost. And we'll credit our merchandise inventory for $18,000. That's to record those costs of goods. So we have a gross profit in this situation of $12,000. So we sold for $30,000, cost of $18,000. Second section says the customer returned $2,000 of good, and the cost of those said goods were $900. So any returns, we reduced the accounts receivable. They haven't paid us yet by $2,000, and recorded a debit to sales returns and allowance, which, as a reminder, is a contra account to our sales revenue of $2,000. But again, they returned us physical goods. We need to add it back to our inventory. So we debit our inventory for $900 and credit our COGS to goods sold for $900. So that's to record the cost of those returned goods. So they're back in our possession to resell to another customer. The third question in here says to record the fact that the customer paid the amount due within the discount period. So if you look back at number 1, we had a terms of 210 net 30. So if you recall from a previous term, that means they get a 2% discount if paid within 10 days, or the net amount of the transaction is due in 30 days. So in this situation, we need to determine what the actual account receivable is. So we need to credit receivable because they've paid it off. How we determine that amount is the original receivable of $30,000 less the amount they returned in sales value of $2,000. So we need to remove the full $28,000. That's the amount that the customer owes us. The discount is only on the outstanding balance. We don't get a discount on the full $30,000 because they returned some items. So if we take 2% of $28,000, we'll get a sales discount of $560. And therefore, the amount of cash that customer will actually pay us is $27,440, which is the $28,000 owing, plus the $560 in discount. Okay, we're going to move on. Let's scroll down to question 3. So here's an example of where we want to set up an allowance for doubtful accounts. In this case, we've decided that we want to set up an allowance for doubtful accounts to the amount of $6,000. There's a $4,000 credit balance in the account right now, and we're asked to prepare the journal entry using the balance sheet method. So in this situation, our allowance for doubtful accounts should be a credit balance because it's a contra account to our accounts receivable. If it's already a $4,000 credit and we want to increase to $6,000, we need to credit the allowance for doubtful accounts to AFDA by an amount of $2,000 to get a balance of $6,000 in that account. So we start with the balance sheet side to credit the AFDA by $2,000. The opposite side of this transaction then is a debit to bad debt expense, which hits our income statement of the $2,000. Hopefully relatively straightforward. If not, please ask. Question 4a, similarly, we use the income statement approach though to estimate our bad debt. And in this situation, we have credit sales. So these are sales to customers on account that totaled $1 million for the year. And the estimated bad debt is 0.5% of those credit sales. And we're asked to prepare the journal entry to record the bad debt expense for the year. So in this situation, we take the 0.5% times the 1 million to get $5,000 as our debit to bad debt expense using the income statement approach. On this situation, the allowance for doubtful accounts is the opposite. So we need to credit the AFDA account for $5,000. And that's to record the estimated bad debt for a year. And just remember, as you write off accounts receivable for customers, you would then credit the accounts receivable for that said customer and debit the AFDA. So this account would always be fluctuating as you actually wrote off accounts receivable. Okay. We'll do one more here, question 5a, and then we'll skip down to a different section on, we'll skip down to a different section in a moment. So question 5a, we have the accounts receivable ledger showing an ending balance of $50,000. And we estimated lump sum, not a percentage, that there's $2,500 of accounts receivable that will become uncollectible. And we need to record the estimation of the bad debt, assuming that the AFDA has a zero balance. So in this situation, we need to increase our AFDA to the whole $2,500 and debit our bad debt expense by the $2,500. So this one, hopefully a little more straightforward than the other two examples. Okay. We'll move down to question 10a, just to walk you through some of this. In 10, we have the company that made total credit sales of $500,000, of which $25,000 was owed at the end of the year. So we had sales of $500,000 and our accounts receivable is only $25,000. On the historical basis, 1% of sales will be uncollectible. So typically 1% of the sales, not of the AR. Jamie Company uses the allowance method for uncollectible receivables and the income statement approach to estimate the amount of receivables that will not be collected. So in this situation, we're asked to record the journal entry at the end of the fiscal year or calendar year, which is the same in this case, December 31st, 2020. And so we take 1% of $500,000, which gives us a $5,000 amount. We need to debit our bad debt expense for that estimate. And we need to credit the AFDA, the allowance for doubtful accounts account, for $5,000. And that's to record the bad debt expense based on the percentage of sales. However, let's roll forward. On January 20th, one of our customers who owes us $500 informs us that she is unable to pay the amount. And now we need to write off that AR. In this situation, because we've set up an allowance already, we need to debit the AFDA for $500 and credit to remove the AR from that customer for $500. So So we're removing the accounts receivable from that customer and applying it to the AFDA that was set up the prior fiscal year. Now let's roll forward. On February 14th, so a few weeks later, she won the lottery, decided to repay the full amount owing to us, and we're asked to prepare the necessary journal entries. In this situation, we need to re-establish the accounts receivable. So we set up the receivable back to the $500 that she owes us, and we will credit the allowance for doubtful accounts to put it back to the AFDA. We already recorded the bad debt expense in December 31st, 2020, so we're not touching bad debt expense at this time. This reinstates the account receivable. After we've done that, we then record the cash receipts. So she paid us the cash of $500, and now our accounts receivable disappears for $500. It's always important to show each part of the transaction. I know many people try to cut corners and would just do a two-line entry where you credit allowance and debit cash. You do not want to do that even in real life. You don't want to do that. Take your time and methodically think through the different steps of the process. Okay. All right, I'm going to skip down to 18A into the next section. So this is where we talk about promissory notes or notes receivable. So here we are, we have a company that operates a sole proprietorship. We sell machines, and it's very high value machines. Often we ask our customers to sign a note because it's high value in sales. So we have a situation where we sold a machine to Neil Marson for $10,000 on November 14th, and originally it was recorded as a receivable. But on December 1st, we asked him to sign a one-year note, which is to be paid on maturity plus 5% interest. And throwing a little wrench here is we have a year end of April 30th. So we're asked to prepare the journal entries to reflect all the transactions from the receivable to the note and the related interest at the appropriate times. So in this situation, and actually we're told it's a periodic inventory system. So in that case, we don't adjust inventory except when we count it. Okay, perpetual, we record a COGS entry every time. Periodic, you only do it at a point in time when you count inventory. So in this situation, on November 14, 2020, we had a sale of $10,000 based on this first paragraph, first sentence. And we set up the accounts receivable for $10,000. Hopefully straightforward. December 1st, we then transfer that AR, so credit the AR and debit notes receivable to set up the note. So we moved the full $10,000 out of notes accounts receivable and set up a note receivable of $10,000 starting December 1st of 2020. Now, the next tricky part is we're told that there's a year end of April 30th. So we know at year ends or even month ends, you would typically accrue income earned or expenses incurred to the proper period using accrual-based accounting. So in this situation, we have 5 months of interest from December 1st, basically till May 1st. So the month of December, January, February, March, and April. So we've got 5 months. If you take the amount of the note receivable, being $10,000 times 5%, you'll have $500 per year. Divide that amount over 12 months times 5 months past, you'll get an amount of interest revenue earned in that fiscal year of $208.33. So therefore, we have a credit interest revenue to earn that revenue of $208.33, and we'll debit interest receivable for $208.33 because we know we'll collect it later from our customer. Lastly, on December 1st, 2020, it was paid on maturity is what we'll assume by our customer. And so we have a multi-line journal entry to record. So we'll start at the bottom of this entry. So at the end of the day, they've paid off the note receivable, the amount that they owed us of $10,000. They're also paying the amount of interest that we recorded as of our fiscal year end of $208.33. Okay. The next part I would do is say, what's the total cash that they're paying us? And it's the $10,000 plus 5% is $10,500. The difference of this transaction will be the interest earned from May 1st to December 1st of 2021, which will be the $291.67. So you can do it that way, or you can calculate 7/12, 5% to determine the $291. At the end of the day, you know the 10.5, you know the 10,000, you know the 208.33. So that's why I encourage you to go through the process that way. And the balance will be the interest revenue earned in the current fiscal year, being May 1st to December 1st of 2021. All right, I'm going to skip down to 22. All right, so we have 22. Question 22 is on page 17 of this document. We have a bunch of accounts receivable for specific customers that total $250,000 at a point in time. We're given information that breaks down into the age of those said receivables. And we see, how much are owed by our customers within 30 days, up to 60, up to 90, and over 90 days. And we're asked a few questions. The first one says, let's look at our 0 to 30 days. And let's look at the amounts owing as a percentage of outstanding. So if we look here, it rounds to 85%. So about 85% of our total AR is under 30 days. And typically, if your AR is under 30 days, it's highly likely that you will collect that amount. Okay, that's really all we can say about it. Next question then says, let's look at the over 90 days, which is this far right column, and let's make a comment on it. If you look at the percentage allocation for these different categories, it is the lowest percent out of all categories, which is good. So this category takes up the lowest percentage of all categories in AR, and which means that of the total amount, the least amount of the $250,000 is owing over 90 days. It's really all we can say. And that's a good thing. If this number was 10, 20, 30, 40% over 90 days compared to other categories much less, I'd be worried that you have too many customers not paying you on time. The last question says, comment on any notable accounts that require attention. And so if we look through the aging, Arden's Art doesn't have any over 90, that's good. That means they typically pay their items within 30 days or up to 90. So Arden's Art is doing okay. However, if we look at West Coast Artworks, they have a bunch under 30 days, a little bit up to 90, but then a whole bunch over 90. So I would comment that they have one of the lowest balances in AR, being the second lowest total AR, but they have the highest amount in over 90 days. So you might want to follow up with West Coast Artworks because there's a chance that it won't be collectible, but maybe they're not planning on paying those. Maybe there's a dispute, or maybe they've lost the invoice and you might be able to collect it. So you need to contact them to ask them and determine if there's a reason why it's outstanding, especially since they're still a current customer. We'll say I worked at organizations that no longer are current and they have an amount over 90 days. Good luck collecting. So you want to keep on this as much as possible in real life. All right, and last one we'll do recorded for today is question 23. It's a little formula one that we looked at some formulas in the lesson this week, where we have a company that has a net AR opening balance of 250 and end of 300,000. We have a total sales amount of 1.7, of which 80% is on credit. Normal credit terms are 30 days. Calculate the days sales outstanding and the AR turnover and make some comments. So if we remember our days sales outstanding formula, it's our average net AR divided by our net credit sales. So out of the total AR, the on account divided by the account sales times 365. So in this case, we look at 250, look at 300, the average of those two is 275. If we look at our total credit sales, we said it's 80% of 1.7 million. So that's 1.36 million. Calculate that, divided by that, times the 365, we'll get 74 days. So our days sales outstanding is 74 days. If I jump to the commentary right now, is if our terms for AR is 30 days, but our days sales outstanding is 74, that's telling me we're having difficulty collecting our AR. We need to do something else about it. Follow up with our customers more, maybe get different customers, whatever that might be. Our accounts receivable turnover looks at net credit sales divided by average net AR. So it's the inverse. So it's the 1.7 million times 80%, or 1.36 million, divided by the average of 300 and 250, which is 275, which means 4.9 times. In this case, we say if our normal credit terms are 30 days, there are 365 days a year. So that means we should be turning over our AR about 12 times per year. So if we're turning it over only 4.9, that to me is not good. We're not collecting our AR fast enough, and we need to be on our customers. So both formulas tell us the same story, that our customers aren't paying as quick as they should be. So those are the only questions I had because I thought there'd be more input. My plan is on Friday, I might record some different exercises just to give you some examples, but don't feel bad to reach out if you have questions or other workbook exercises you'd like me to go through. Okay. Last thing before I stop the recording, it's just a reminder in AME. So you'll be section 01 PP little. Under chapter 1, I strongly encourage you to complete chapter 1 this week. You'll have to do the tutorials before the quiz will open for you and the post-class homework. So the quiz is not due until Monday, the 20th, but I strongly recommend you get it done before then, just to keep up with the fact that we'll be looking at chapter 2 next week. And the post-class homework for chapter 1 isn't due until September 26th. That's this post-class homework, and you can either see that on the schedule at a glance that I reviewed last week, or if you click in it, it'll tell you when it closes. Okay, let's go back to here for a second. So again, I strongly encourage you this week to finish all the chapter 1 items, so the tutorials, the quiz, and the post-class. I always recommend too, if at all possible, either before or simultaneous to you watching the recorded lesson for chapters, to look at the tutorials. I would always encourage my students to review the tutorials, listen or attend a lecture that reinforces some of the learning, ask any questions you may have, do some workbook exercises as practice if desired. Again, they're not graded. Once you're comfortable with the practice you've done, then do the quiz and post-class homework. So I'll stop the share. Hopefully anybody that did watch this find this helpful. And again, don't feel bad to reach out anytime, please. Take care.